So welcome to Office Hours, a tax podcast by Fujikawa Associates. And we're your hosts. My name's Josh Baldovino. I'm one of Derek's clients, and this is Derek Fujikawa, who's the managing partner of Fujikawa Associates. Derek, welcome back from vacation.
Thank you.
And while you were gone, I was debating if I should sell one of my properties or what I should do with it. So I'd love your help on it.
Sure, anytime.
All right, so we made this little calculator here, and honestly, this is an honest conversation. If you're listening for the first time, bought some rentals about 4 years ago, and this is one of the first early ones. And I know there's some different tax implications in terms of short-term, long-term, or 1031ing.
Yes.
We try to make this basic and as simple as possible. Obviously, there's a couple nuances, but from a high-level perspective, at least just kind of get the gears turning. All right, so I will fill in the dark blues here, and I made it also auto-populate here. So Derek, just to kind of give you the rough numbers, and then you walk me through what the implications are.
Okay.
So I bought this, and I'm going to round some numbers here, for $130,000. And my down payment was $30,000 on this one.
Okay.
We've made some improvements. I want to say overall, we've probably put in over the last 4 years about $10,000 in random improvements here and there.
Okay.
The last time I ran comps on this, it's $205,000. So, and we had some nice COVID appreciation, obviously low interest rates and things like that. Stabilized a little bit. Current loan balance is about $90,000. Might be a little bit less, but let's err on the higher side. It rents for $1,400 a month. And our mortgage is actually $700, but let's just say with other miscellaneous things, let's just round up to $800.
Okay.
So what am I looking at here, Derek?
So cash flowing pretty nicely on that property. But yeah, so you're looking at roughly 115K in equity there. So you have some options, and depending on when you bought it and what you want to do with the proceeds, there's kind of a wide range of, I guess, what you could reinvest or use that money for. So, I don't know. We can get into the different options if you'd like.
Yeah. I mean, so I guess just looking at this right now, again, these are quick generalizations, and I didn't factor in saving for vacancies and maintenance and things like that. So again, that's also kind of why I rounded up a little bit.
Yep.
So if you're going to use this for yourself, by the way, if you want to download this, click the link down in the description, or if you're on Instagram or anywhere else, just comment. What should we have them comment here? Comment exit, and we'll send you a link to go ahead and download this and run this exercise for yourself. So description, comment exit. Okay, so yeah, I mean, cash flow is decent, right? $600. And then I have the return on capital versus return on equity. Can you break that down of what that means?
So return on capital, isn't return on equity usually higher than return on capital, or?
Well, so I had this as, I put it as like initial capital invested.
Oh, okay. So your down payment. Okay, I see.
Yeah. Like CapEx. And how do I spell initial?
Yeah.
Initial. That's spelled right. And then return on equity is just the equity balance, which is just.
I see.
So when I'm kind of coming up with my numbers of, okay, we've owned this for 4 years now. Should we sell? In terms of return on initial capital, I mean, you're not going to find this deal today anymore.
Sure.
All right. Like, we're not going to get an 18% return
Yeah.
and lock in a 3% interest rate. Like, it's just not going to happen. So on that initial 40K invested, I'm getting an 18% return, which is awesome.
That is.
But if I'm going my current equity, which in this is the current market value minus the loan balance, there's a little bit of cash in there. A lot of cash, actually.
Yeah.
A lot of value in there. I'm only getting 8%. So that's my debate of like, all right, Derek, if I did something, what's the implications? How would you move?
Yeah. So
what do you think?
So I mean, 8% really isn't bad on your equity, although, you have to look at, if you're going to reinvest that in a new property, you're probably going to have a much higher interest rate. And so your expense ratio is going to be much higher. And so you may not be able to even get, say, an 8% return on your total investment. So you have to kind of run those numbers. Again, it's all running the numbers, right? I mean, it's hard to say looking at this and not looking at the other end of what else you're trying to reinvest that money into. So you'd want to get, more than 8% return on your next investment in order to actually come out ahead in any type of transaction that you're going to make.
Yeah, I mean, obviously there's a few different, we can sell it and I guess, yeah, but let's break down kind of the examples of the
Mhm.
different sales and potential
Sure.
vehicles. So short-term sale, why is that different?
So that doesn't necessarily apply in your situation, but say you just bought that house this year for 130K. You put 30% down, put 10% into it. So, your basis is 140. So say all these numbers are basically the same. And based on your improvements and everything, it increased that 205 number. If you were to turn around and sell it within 1 year, within less than a year of purchasing it, then the gain on that sale would be a short-term capital gain, and that's taxed at your ordinary income rate. So, in this instance, we're assuming that you're in the 35% tax bracket. So you take your sales price minus your commissions and closing costs and everything else like that you'd receive that are deductible, and then subtract out your basis, which is that 140, and then multiply that by your 35% tax rate. So that's where we get this kind of roughly $16,000 of tax on that. And this is only on the federal side.
Gotcha.
So you would come out with about $80,000 after that. So the way I got to that was you take the estimated sales price, that 186,550, and then subtract out your current loan balance and subtract out the taxes on that, and that's what you'd end up with. This is, again, this not factoring in state taxes.
There's a few other assumptions that we put into this too, right? So you
Yes.
have,
Yeah.
your commissions could change, your closing costs can
Mhm.
change, obviously your brackets change, but
Yes.
again, rough, just
Yeah.
back of the
The big
napkin.
the big caveat is, yes, we're using a lot of assumptions here just to give you some ideas, but we're using the same assumptions for all three scenarios, so you can get an idea of how they affect the transaction.
Okay, so in this case, you could potentially turn that initial 40 and doubled it into
Mhm.
80 if that was a short term. And so cool, it's
Yes.
a win. And now that's the vehicle there. So on the long term, again,
Mhm.
all numbers are the same. The
Yes.
thing that changes is line 21 here.
Yes, the tax rate drops to, say, 20%. So your taxes drop, as you can see, about $7,000. So you net 87 instead of 80,000 at the end of the day.
Okay. And
So
then,
mhm.
and then the time difference between this, that's under a year versus over a year, right?
Yes. Under a year or 1 year or more. 1 year or longer is considered long term.
Okay. Okay.
Mhm.
And like, as I think about this, let's
Mhm.
just say I had this property for 10 months and I'm thinking, all right, is it
Mhm.
worth waiting 2 months? Is it not worth waiting 2 months? Is
Yes.
that 7,000? Again, in this specific scenario, is worth selling? I mean,
Mhm.
sometimes like that's not a huge significant difference. So
No, yeah. And you have to look at your carrying costs. If you're renting it out, then you may be kind of breaking even or even a small negative cash flow. But if you have some significant carrying costs, then you have to weigh that against, say, holding it for 2 or 3 months to get to that 1 year.
gotcha. Okay.
Mhm.
And then 1031, of course, that seems like that's a baseline of what most people think about when it comes into real estate investing.
Yes,
Like
yes.
this.
Yeah, so if you are trying to move into a new property, then 1031 exchange oftentimes is a great vehicle because you can defer the taxes on the gain. So either that 16 or the 9 that you would pay, short term or long term, would be deferred and kind of integrated into the new property that you buy. So you don't get to just eliminate that tax, but it just gets pushed forward and will get taxed when you ultimately sell the next property. Or if you exchange again, then that, it just keeps getting pushed back if you keep exchanging, but it just carries forward and, through time. So basically all the same calculations, all the same assumptions, but you don't have the tax number down there. And so you get the full amount of the gain. So you can use that to reinvest into a new property. And so that bottom line there kind of gives you an idea. If you were to take the proceeds and use that to buy a new property and use the proceeds that's 20% down, if you do the 1031 exchange, you can buy a property that's, $80,000 more than if you were to just do a short-term sale on a property and then use those proceeds to buy a new property. So it's a pretty powerful tool.
Yeah, I mean, when you're talking about percentage wise, like that is
Mhm.
almost $100,000 difference. And that is,
Yeah.
significant difference in buying power.
Yeah, and we're looking at a $130,000 house too. If we're looking at a $500,000 house, multiply that by 4, and you could have a much larger difference in the property that you can exchange into.
Yeah, and then really the true exercise for this is I have 2 of these houses that are
Mhm,
basically within a half mile of each other, basically at the same
mhm.
numbers.
Yeah.
So my question
Mhm,
is there something that I feel relatively confident that I could minus fees after all the holding costs, after all the transactions, yada yada?
mhm,
How feasible would it be for me to find something that would get
mhm.
better than 8%, right?
Yeah, yeah. And so the hard part is you have a low interest loan on the existing properties, and you'd be moving into a high interest loan. So you really have to run the numbers and see what will net you the best result.
Okay, but this is a fun exercise. I
Yeah.
know there's a lot of people who listen to this who've bought a handful of rentals
Hmm.
in the last 5 years since COVID, and so
Yep.
I have not ran this on all of my properties, and I will play around with
Mhm.
this afterwards. Derek, anything else that people should consider in terms of playing around and plugging this away?
If you want, you can add another line for the state taxes. If you're in California, it's going to be, 9.3%, potentially up to 12.3% in state income taxes. So you could add a line just to kind of get a better idea of what your bottom line number will be. But every state's different, so it's hard to kind of put an estimated line number in there. But that's just one other major thing to consider in this whole scenario.
Yeah, yeah. I mean, this is the first initial thought process in terms of
Mhm.
should you exit a
Yeah.
property.
Hmm.
Again, if you let me close that one out. If you want to make a copy of this for yourself, we left it down in the description, or
Hmm.
just comment down exit if you're on Instagram. And when you get to the link, because I always get some questions when I have these calculators, file, make a copy, because this will not be editable when you get there. So make your own copy. And again, there are a lot of assumptions here. And if you have specific questions about it, make sure you reach out to Derek. I'll also leave his contact down below so that way you can run through your specific scenario
Hmm.
and see if it makes sense for you. But
Great.
all right, Derek. So your thing is if I'm thinking about exiting these 2 properties, I
Hmm.
gotta find something here. Any ideas of what I could potentially exit them into?
So if you 1031 exchange, then you're going to need another rental property, right? It could be commercial, it could be residential, but it just has to be a rental property. If you're not, if you can't find anything suitable, there are certain types of funds that you can actually exchange into. They're very limited, and you have to be an accredited investor, but there are some investment funds that you can invest 1031 exchange out of real property into, these funds that invest in other real properties that you could use as maybe a stopgap for a while, and then get back into the rental property game sometime later down the road. But other than that, yeah, with the 1031 exchange, you really need to identify your properties and make sure that you can buy it within the guidelines of the 1031 exchange. Otherwise, you could find yourself paying all those taxes in the first 2 lines.
Well, I made it super easy because we've actually already done a whole 1031 episode. So I
Yes, we
will
have.
leave that also linked down in the description below. That way
Mhm,
you can jump to that. I mean, just for fun, I was looking again, this house that I'm in this scenario, this is a real rental that I have. And I was looking at today, like on market, what could it be? Right. So I
mhm.
went straight for sale, filter multifamily. And then I'm actually going from high to low. One
Yeah.
that was, I mean, I didn't run any numbers on it, but one, I mean, it's a fourplex that's fully renovated for 539K.
Wow.
Although, and 1% rule, which means that these are all, how many bedrooms is this? Where am I at? Shoemaker, 5 something. Faster. Oh, on the next page. How many bedrooms is this one? 3 bedrooms, 1 bath. Wow.
Hmm.
Wow. That means that in Columbus, this will probably rent for 1,600 bucks a month,
Wow.
which is gross rents of 6 grand.
Huh.
So
Huh.
interesting. I now need to run some numbers.
Yeah. Yeah.
Although thinking about it, I would probably want something that has a little bit more value add play. Like these ones do look
Sure. Yeah.
like they're all fully done, which means that most of the meat have been taken off the bone,
Yeah,
although
not
the
a lot of
exterior
natural.
could look.
Maybe the exterior, yeah.
But some different options. So we'll play again. If you want to get a copy of this for yourself, it's in the description. If not, make sure to share this or like and subscribe and share this with someone who's thinking about exiting, because you should run this, I don't know, at least once a year, I guess. Just plug in these numbers. It takes a minute.
Yeah, yeah.
Well, Derek, I appreciate you sharing, and we will see you guys all in the next one.
Yep.
Thanks, guys.